So, how exactly does a company manage to generate like 40% more profit with 26 million fewer customers?
I mean, mathematically, it sounds completely impossible, right? But it actually happened.
It really did. And welcome to the Deep Dive, everyone. Today, we are digging into an earnings report that honestly just defies conventional financial gravity.
Yeah, it's wild. We are looking at the Q2 2026 earnings call for AMC Theatres.
And if you're a regular listener, you know exactly how we do things here. We're running this through our Talk Tickers format.
Which means we are putting all the social media noise aside. We don't care about the narrative today.
Exactly. We are prioritizing a data-forward, totally plain language, actionable analysis of the raw numbers. We're going to translate all that Wall Street jargon so you can actually understand what it means for your portfolio.
And, you know, context is just incredibly critical here before we even look at a single digit from Q2.
Oh, for sure.
Because you really can't evaluate AMC without acknowledging its history, right? It's like the ultimate battleground stock. Seriously. I mean, since, 2020, this company has essentially been living in financial purgatory.
Yeah, exactly. It survived that near-death experience during the pandemic, and then it became the absolute poster child for the whole retail investor meme stock phenomenon.
While simultaneously being aggressively shorted by hedge funds, who were basically just betting on its bankruptcy.
Right. For half a decade, the big question wasn't even, can AMC grow? It was literally just, can they survive their own debt load?
Which is exactly why the claims from this recent Q2 earnings call are just so incredibly jarring.
Yeah, management didn't just hop on the call and announce a mildly profitable quarter.
No, they went way further. They claimed this was the best fundamental performance in the company's entire 106-year history.
I mean, think about that. They are stating on the record that they just had a better quarter than the whole 1980s multiplex boom.
Or the stadium seating revolution in the late 90s. Or even the peak box office years we saw in the mid-2010s. Right. And whenever a management team makes a historical claim that massive, your immediate reaction as an investor needs to be skepticism.
Absolutely. You have to look under the hood and verify the mechanics.
Exactly. Are these actual core operational improvements, or is this just some fancy accounting wizardry?
Right. Like, are they actually making cash from showing movies, or are they just shuffling numbers around on a balance sheet to look good?
Well, let's unpack it. Let's run the numbers and see what's really going on.
Okay, so we're looking at Q2, which is April through June of 2026. The top-line revenue came in at approximately $1.6 billion.
Which represents a 14.2% increase year over year.
Yeah, which is a solid number. It's definitely a beat, but, not necessarily a historical anomaly on its own.
No, the number that actually forced Wall Street analysts to just tear up their models was the adjusted EBITDA.
Oh, man, yeah. That came in at $321.4 million.
I mean, that is a 70% increase compared to the same exact quarter last year.
Which is insane.
It is, and it marks the first time the company has ever crossed that $300 million threshold in a single quarter.
And they paired that massive EBITDA with $190.1 million in free cash flow.
Right. But let's pause there for a second.
Yeah, good idea. We should probably define our terms clearly for anyone who might be newer to evaluating corporate earnings calls.
Exactly. When a company reports adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, what are they actually adjusting?
Right. Like, why shouldn't you just look at their standard net income or, their earnings per share?
It's a really great question, and it matters a lot here. So net income, or GAAP earnings, includes a lot of non-cash expenses.
And in the theater business, the biggest culprit there is depreciation, right?
Spot on. AMC owns or leases thousands of massive physical buildings, expensive projectors, and all those seating arrays.
Right.
And for tax and accounting purposes, all those physical assets lose value every single year.
So that depreciation hits the net income line and makes the company look a lot less profitable than it actually is, at least on a pure cash basis.
Exactly. So adjusted EBITDA essentially strips out those phantom non-cash charges.
And what about the adjusted part of that acronym?
The adjusted part means management is also pulling out irregular one-time costs, stuff like restructuring fees or penalties for retiring debt early or stock-based compensation.
Okay, so adjusted EBITDA basically gives us a much cleaner look at the actual operational cash the business generated just from selling movie tickets and popcorn over those 3 months.
Exactly. It's the core engine of the business. And that operational cash metric didn't just inch up, the margin on it expanded massively.
Yeah, their adjusted EBITDA margin jumped from 13.6% in Q2 of 2025 to 20.1% this quarter.
Which begs the question, how does a mature company expand its profit margins by almost 7 full percentage points in just 12 months?
Right, that's not normal. So what's the secret?
It basically comes down to this financial principle known as the flow-through rate.
Okay, break that down for us.
So on the call, management specifically highlighted this 66% flow-through rate.
Which means what exactly?
Flow-through just measures the percentage of incremental revenue that converts directly into pure profit.
Okay, so let's apply the math to this specific quarter then.
Sure. So compared to Q2 of last year, AMC brought in roughly $200 million in new additional revenue.
Right, so that's the extra money on top of their baseline revenue.
Precisely. Now, normally, if their costs had grown at the exact same pace as their revenue, you would expect their actual profit to only bump up just a little bit.
Because they'd be spending more to make more.
Exactly. But out of that $200 million in new revenue, $131.9 million dropped straight down to the adjusted EBITDA line.
Wow. So that's the 66% flow through they were bragging about.
Yes. It proves that AMC successfully capped its operating expenses.
Like rent and payroll.
Exactly. They kept their rent, their corporate overhead, and their baseline staffing costs essentially totally flat.
Which allowed the lion's share of that new revenue to basically just become pure profit.
Right.
I kind of want to visualize this for a second because understanding this operating leverage is really the key to unlocking this entire earnings report.
Go for it.
So think about a commercial airline flight, right? Like a flight from New York to Los Angeles.
Okay, tracking.
The airline has to pay for the pilots, the jet fuel, the leasing of the aircraft, and the airport gate fees, regardless of whether there are 10 people on the plane or 200 people on the plane.
Right. Those are heavy fixed costs. They don't change.
Exactly. Because of that, the first 100 tickets they sell might just purely go toward covering those expenses. The airline just breaks even.
Yep.
But ticket number 101 or to ticket number 102, almost every single dollar from those extra tickets is pure profit because the baseline cost of flying the plane to LA is already covered.
That is the absolute perfect framework for this because the theater business operates on that exact same high fixed cost, high operating leverage model.
Right. You have to pay the rent on a 50,000 square foot building, regardless of who shows up.
You have to heat it, cool it, run the projectors, and staff the concession stand, whether the auditorium has 5 people in it or 500 people in it.
So AMC covered all their fixed baseline costs, and then they managed to drive significant additional revenue right on top of that.
Exactly. Which brings us to arguably the most critical operational question of the whole episode.
Where did that extra revenue actually come from?
Right, because you can't achieve a 20% margin just through cost cutting alone. You can't just cut your way to growth.
No, you actually need money walking through the front door at some point.
And they got it. The foundation of that revenue growth was just a raw increase in foot traffic.
The actual number of humans in the building.
Yeah. Globally, over 71 million guests visited an AMC theater in the second quarter.
Which is huge. That represents a 13.5% increase in physical attendance compared to last year.
Right. And when we look at the broader industry context, AMC's performance starts to look even more impressive.
How so?
Well, the overall North American box office grew by 10.7% during this period, but AMC's domestic ticket revenue grew by 11.4%.
So they outpaced the broader industry.
Yes, exactly.
Meaning they aren't just benefiting from a general post-strike recovery, they are actively stealing market share away from competitors like Regal or Cinemark.
Yeah, they're eating their lunch. And the international picture was even stronger, honestly.
Oh, really? I didn't see the international breakdown.
Yeah, their European attendance grew by nearly 18%. And their European adjusted EBITDA actually quadrupled compared to the prior year.
Quadrupled? Okay, I actually have to step in and push back here for a second.
Sir, what's up?
Because whenever I see a legacy retail or entertainment company squeezing out record profits while the broader industry is just sort of slowly recovering, my alarm bells go off.
That's fair.
We've seen this exact playbook before. A company realizes they have a shrinking customer base, so they just aggressively jack up prices on the remaining loyalists to maintain their revenue.
I see where you're going.
Right. Like, are they just gouging families at the box office? Because if the strategy is simply to make a Friday night movie unaffordable for a family of 4, That's just a short-term cash grab.
Right. It's not a sustainable structural turnaround at all.
Exactly. You're just burning your customer base for a quick buck.
It is the exact right question to ask. And honestly, it's a super common pitfall for mature businesses.
So are they doing it?
No. The underlying data here reveals a totally different mechanism. The revenue increase is not being driven by across-the-board punitive price hikes on standard tickets.
Okay, so what's driving it then?
It's being driven by what financial analysts call a mix shift.
Okay, explain the mechanics of a mix shift in this specific context.
So a mix shift occurs when the proportion of high-margin products sold increases relative to lower-margin products.
Without necessarily raising the baseline price of the entry-level product, right?
Precisely. In AMC's case, audiences are basically voluntarily migrating away from the standard screens, and they're actively opting to pay a premium for an elevated viewing experience.
Oh, I see. They are choosing premium large formats, or PLFs.
Yes.
So we are talking about the IMAX screens, the Dolby Cinema auditoriums, and AMC's proprietary extra large, or XL, screens.
Correct. The consumer behavior has fundamentally changed. People don't just want to see a movie, they want an event.
Right.
Let's look at the statistics management provided regarding Christopher Nolan's recent release, The Odyssey.
Okay.
Premium screens account for roughly 8% of AMC's total global screen footprint, just 8%.
Very small slice of the pie.
Right. But during the opening weekend for The Odyssey, that small 8% footprint generated 50% of the total ticket gross for the entire company.
Wait, seriously, let that sink in for a second, guys. 8% of the physical real estate generated half the total revenue.
It's wild.
I mean, returning to our airline analogy from earlier,
Yeah.
This is the equivalent of an airline realizing they can generate half their route profit exclusively from the first-class cabin.
Exactly. There are still standard economy seats available for the price-conscious consumer who just wants to see the movie.
But there is this massive, totally underserved appetite for a premium experiential product.
Right, and AMC has strategically positioned itself to totally monopolize that appetite.
What's their footprint look like for those premium screens?
They currently operate roughly 750 premium screens globally.
Wow.
Yeah, that includes over 220 IMAX screens and over 180 Dolby Cinema screens. No other theatrical exhibitor in the world possesses that level of premium scale.
So they have essentially cornered the market on the first-class cinematic experience.
Completely.
And, the beauty of that mix shift is that it creates a massive halo effect.
Oh, at the concession stand, you mean?
Yeah. Think about it. If a consumer has already made the psychological decision to spend an extra $7 or $8 for an IMAX ticket, they are far less price sensitive when they walk past the popcorn.
That's a great point.
The person paying a premium for the absolute best seat in the house is not the same person sneaking a candy bar in their jacket pocket to save $2.
No, they're treating themselves, and the earnings data bears that out explicitly.
What were the concession numbers?
Food and beverage revenue grew by 15.3% globally.
Nice.
But, and this is where it gets crazy, there is a secondary revenue category that management tracks, simply labeled Other Revenue, and that category grew by 16.1%. And honestly, this category represents one of the most fascinating micro case studies of this entire turnaround story.
Okay, this is the merchandise, right?
Yes, it's the merchandise, the movie-themed popcorn buckets, the collectible cups, and even their push into retail grocery popcorn.
I really want to spend a minute on this because it highlights a total shift in corporate culture at AMC.
Oh, absolutely.
Like, think back to 2019. AMC made exactly $0 from movie-themed merchandise.
Yeah,
Zero.
Right. They simply didn't view themselves as a retail company back then.
Exactly. They just thought of themselves as a landlord that leased out space to movie studios and sold fountain soda.
But starting a few years ago, really picking up steam with those viral, almost ridiculous popcorn buckets for films like Dune and Deadpool.
Oh man, the Dune bucket.
Right. But they realized their lobbies were essentially high-traffic retail storefronts.
And on this call, management projected they will hit $100 million in global merchandise sales for the full year of 2026.
It's incredible. They manifested a $100 million extremely high-margin revenue stream completely out of thin air simply by rethinking the physical space they already controlled.
It's brilliant. But, speaking of physical space, the real estate itself has been a major point of contention for this stock over the years.
Definitely.
Because legacy retail is notorious for being dragged down by bad real estate. Malls die, demographics shift, and companies just get trapped in these terrible 20-year leases.
Yep. The blockbuster video effect.
Right. So how is AMC managing their physical footprint to avoid that?
They have been executing this very quiet, very systematic pruning of their portfolio.
Okay, what does that look like in numbers?
Well, since 2020, AMC has permanently closed 225 underperforming theaters.
Wow.
And over that same exact period, they opened 66 brand new locations.
So if you do the math, they've reduced their global circuit by 159 theaters, which is roughly a 16% reduction in their total physical footprint.
Right. But the underlying metrics of those moves are highly accretive.
Meaning they're adding value despite shrinking.
Exactly. The 66 new theaters they opened are generating higher gross revenues and higher net profits than all 225 of the theaters they shuttered combined.
So they basically just surgically removed the dead weight that was acting as a drag on their EBITDA margins.
Yes.
I imagine closing that many theaters also radically changes the dynamic with their landlords, right?
Oh, it completely flipped the leverage.
Yeah.
Theater leases are highly complex. They often involve a base fixed rent plus a percentage rent based on the theater's actual revenue.
Okay.
So when AMC was teetering on the edge of bankruptcy in 2020 and 2021, they used that distress status to force landlords back to the negotiating table.
Basically saying, work with us or we're gone.
Exactly. By demonstrating a willingness to actually lock the doors and hand the keys back on 225 locations, they proved to the remaining landlords that they were not bluffing.
Wow.
And that credibility allowed them to negotiate highly favorable master lease amendments, huge rent deferrals, and much lower base rents across their most profitable locations.
That's a masterclass in negotiation, honestly. So if we synthesize the operational side of the business right now, they have a smaller physical footprint, but those remaining theaters are vastly more efficient.
Right.
They are capturing a massive premium on ticket prices through IMAX and Dolby. They are selling high-margin collectibles out of the lobby, and they forced landlords to lower their fixed costs.
Exactly. Operationally, the business is a machine right now.
But, and this is a massive bet, operational efficiency doesn't mean much if the corporate entity is still suffocating under pandemic-era loans.
Right.
So how much time did these operational wins actually buy them?
And this is the pivot point of the entire analysis today, because you are absolutely right.
Right. Because for years, the short thesis against AMC had literally nothing to do with the movies being released.
No, the bear case was entirely mathematical. It was basically, it does not matter how many popcorn buckets they sell, their debt load will trigger a default and they will be forced into Chapter 11 restructuring.
So we have to look at the balance sheet.
We do.
Is the elephant in the room? Give us the exact numbers. Where does the debt stand today?
The restructuring has been monumental. Since the end of 2020, AMC has reduced its principal debt balance by $1.7 billion.
Okay, let's be brutally honest about how they achieved that, though.
Go ahead.
Because it wasn't just by selling movie tickets. The retail investor base, the people listening to this right now, they basically footed a massive portion of that bill.
Yeah, we have to acknowledge that.
Management used the meme stock rallies to issue millions of new shares. They heavily diluted the existing shareholders to raise cash and pay down that debt.
It's true.
I just want to be super clear for the listeners.
Yeah.
AMC survived because it diluted its equity base.
That is a completely factual assessment of the last 4 years. The share count expanded exponentially, and the value of individual shares was heavily diluted just to save the corporate entity.
Right.
Management basically issued equity at premium valuations during those retail rallies to extinguish debt at a massive discount.
Okay, but as we analyze this specific quarter, Q2 of 2026.
Right. We are actually seeing a shift away from pure dilution and moving toward complex financial engineering.
Okay, what did they do?
In Q2 alone, they executed several major balance sheet maneuvers. First, they successfully refinanced $400 million of debt that was coming due in 2027.
And pushed that maturity out by 4 years.
Yes.
So they essentially kicked the can down the road on the most immediate threat.
Exactly. Second, they eliminated $155.8 million of exchangeable debt that was due in 2030.
Wait, explain exchangeable debt for the listeners. How does a company just magically eliminate $150 million in obligations?
So exchangeable debt is similar to convertible bonds. It's a type of loan where the lender has the option to trade the debt they are owed for shares of the company's stock. usually at a predetermined price.
Okay, got it.
So AMC negotiated with these specific debt holders to convert that $155.8 million of debt into equity.
So it does result in some dilution.
Yes, it results in some dilution, but it completely removes the principal debt obligation and all the associated interest payments from the balance sheet permanently.
Which frees up a ton of cash flow.
Exactly.
What else did they execute in Q2?
They used cash on hand to redeem $125.5 million in high-interest subordinated notes.
All right, let's break down that terminology too. What makes a note subordinated, and why was it so critical to get those specific notes off the books?
Good question. In corporate finance, a company's debt has a hierarchy, which we call the capital stack.
Okay.
At the very top of the stack is senior secured debt. If a company goes bankrupt, the senior secured lenders get paid first because their loans are backed by physical collateral.
Like the actual theater buildings.
Right. And because they take on less risk, they charge a much lower interest rate.
Makes sense.
Now, subordinated notes sit much lower in the capital stack. They are unsecured.
Meaning no collateral.
Right. If AMC went bankrupt, these note holders would be near the very back of the line to get paid. So because they are taking on significantly higher risk, they charge a much, much higher interest rate to compensate.
Oh, I see. So they are essentially these toxic double-digit interest rate loans that just bleed a company's cash reserves dry every month.
Exactly. By paying off $125.5 million of these specific subordinated notes, AMC stopped the bleeding on their absolute most expensive debt.
Wow. Okay, so after all that, the refinancing, the debt-to-equity conversions, and the open market repurchases, what does the actual runway look like now? Like, when is the big bill due?
Management was very clear in the call. As a result of these Q2 maneuvers, AMC has no significant debt maturities until 2029.
That is massive.
It is. They have secured a clear, multi-year runway to operate without the existential threat of a massive debt repayment coming due.
And how much cash do they have on hand right now?
They ended the quarter with $778 million in unrestricted cash on the balance sheet.
I mean, that is a fortress compared to where they were just a few years ago.
It really is night and day.
But while we are on the topic of debt, I really want to highlight a specific mechanism you pulled from the filings regarding their interest rates.
Oh, yeah.
Because honestly, this is perhaps the most actionable, elegant piece of financial engineering in the entire report, and it ties directly back to our discussion earlier on operating leverage.
You are referring to the SOFR spread reduction triggers.
Yes. Walk us through this. How does a profitable quarter automatically rewrite the terms of their loans? It's fascinating.
It really is. So when a massive corporation like AMC borrows money, the interest rate is rarely just a static, fixed number.
Right.
It is usually structured as a base rate, often the secured overnight financing rate, or SOFR plus a spread or a margin.
And that spread is dictated by the perceived risk of the borrower, right?
Exactly. The higher the risk, the wider the spread the bank charges.
And how do banks calculate that risk on a day-to-day basis?
Through leverage ratio covenants. The most common one is the debt to EBITDA ratio.
Okay, so breaking that down.
It simply compares how much total debt a company has to how much cash it generates.
So if your debt is 10 times your EBITDA, you are highly risky.
Right, but if it's only 3 times your EBITDA, you are relatively safe.
Got it. So going into Q2, AMC's CFO, Sean Goodman, had previously negotiated these automatic step-down triggers into their loan documents based on these exact ratios.
Correct. The contracts basically stipulated that if AMC could improve its leverage ratio beyond certain predefined thresholds, the interest rate spread they paid would automatically decrease.
And because AMC posted that massive $321.4 million adjusted EBITDA number this quarter,
their debt to EBITDA ratio plummeted. They became mathematically less risky overnight.
And the trigger was tripped.
Yes. Without having to go back to the negotiating table and without paying millions in investment banking fees to restructure, the interest rate on 75% of their remaining term loan debt automatically dropped.
That is incredible. And what's the actual cash impact of that?
Management estimates this single automated mechanism will save the company approximately $51 million in cash interest expense annually going forward.
$51 million a year going straight back to the bottom line, purely as a byproduct of running a more efficient operation.
Yeah.
I mean, the profits fed the balance sheet, which lowered the debt costs, which then increases future profits. It is a complete virtuous cycle.
It's corporate finance operating exactly how it's supposed to.
But we do have to look forward. The balance sheet is stabilized until 2029, and the operating leverage is clearly dialed in.
Right.
What is the magic number? Like, what macro conditions does AMC need to actually sustain this kind of cash generation?
So during the Q&A portion of the earnings call, an analyst asked management this exact question.
Okay, and what did they say?
The CEO provided a very specific baseline. He stated that for AMC to remain consistently free cash flow positive on a rolling 12-month basis.
Meaning they are actually putting cash in the bank after all expenses, interest, and capital expenditures are paid.
Exactly. For that to happen, the overall global box office needs to hit roughly $10.4 billion.
Okay, let's contextualize that $10.4 billion figure. Where are we currently at, and what is coming down the pipeline to actually get us there?
Well, the industry is currently still recovering from the dual impacts of the pandemic and the subsequent Hollywood writer and actor strikes.
Right, which severely delayed the whole production pipeline.
Exactly.
Yeah.
So because of that, we are currently pacing a bit below that $10.4 billion mark.
Ah, okay.
However, management provided extensive guidance on the upcoming 12 to 18-month film slate, and it is heavily stacked with reliable, high-grossing intellectual property.
Right. I mean, we just saw the Odyssey pull in a $124 million domestic opening weekend.
Yep.
But looking at the back half of the year, Sony is preparing to release Spider-Man Brand New Day.
And early tracking suggests that could honestly break global records.
Right. And following that, Warner Brothers has Dune Part 3, and Disney is positioning Avengers Doomsday for a massive holiday release.
So the sheer volume of those tentpole franchises is expected to easily push the aggregate industry box office past that $10.4 billion threshold in 2026.
Awesome. And AMC is not just passively waiting for those movies to arrive either.
No, they are actively deploying capital to ensure they extract maximum revenue from every single ticket sold.
Right. They provided guidance for capital expenditures, or CapEx, estimating a spend of between $200 million and $235 million over the next year.
And historically, theater CapEx was a bit of a black hole.
Oh yeah, companies would spend millions ripping out seats and installing new carpets with very little measurable return on investment.
Right. But how is this current management team deploying that $200 million differently?
Well, they are executing a hyper-targeted strategy focused almost exclusively on high-return, premium format expansions.
Which ties right back into that mix shift we discussed earlier.
Exactly. They plan to add between 150 and 250 new premium large format and XL auditoriums.
And the unit economics on some of these specific upgrades are just remarkable.
Let's look at the mechanics of an AMC XL upgrade, because this is one of the most interesting data points from the call.
Yeah, how exactly does a theater upgrade a normal screen to an XL screen, and what does it actually cost them?
Well, it is surprisingly efficient. They are not knocking down structural walls or building brand new auditoriums from scratch.
Okay.
An XL upgrade involves retrofitting an existing appropriately sized auditorium.
So what are they swapping out?
They replace the standard projection lens to increase the luminance and clarity. They install a new high-gain silver screen to optimize the image. They upgrade the sound processing hardware.
And add specific premium branding to the physical entrance of the auditorium, right?
Yes, exactly.
Yeah.
And the CEO stated that they can execute this entire physical upgrade for less than $20,000 per screen.
$20,000 in commercial real estate is literally a rounding error. It is virtually nothing.
I know. But the return on that $20,000 is immediate.
Because once that screen is branded as an XL format, AMC charges a 10% price premium on every ticket sold for that specific auditorium in perpetuity.
Right. The internal rate of return on that specific CapEx deployment is astronomical. It basically pays for itself in a matter of weeks and then generates pure margin for the life of the theater.
It's so smart. We also have to talk about the seating geometry, though, because this is another area where the mechanics of their CapEx strategy are brilliant.
Oh, the seats. Yes. So about a decade ago, the entire industry realized that customers absolutely loved massive, plush, full recliner seats.
Yeah, the transition to recliners honestly saved the industry at the time.
It did. But there's a mathematical problem with full recliners.
They take up a tremendous amount of physical space.
Exactly. If you retrofit a traditional 200-seat auditorium with full recliners, you might drop the capacity down to like 80 seats.
You lose over half your capacity.
Right. Now, in a low-traffic suburban theater, that's fine because you were never filling the 200 seats anyway.
Right. You're just making the 80 people who do show up more comfortable.
Exactly. But what happens in their flagship locations? What happens in Burbank, California, or Lincoln Square in Manhattan, where the theater regularly sells out?
If you put full recliners in a sold-out theater, You are actively destroying revenue.
Yes.
You are turning away paying customers because you reduced your physical inventory of seats.
Precisely. So AMC engineered a solution called the Club Rocker.
Okay, what is that?
It is a premium, highly comfortable upgraded seat, but it does not fully recline.
Oh.
The geometry of the seat allows them to provide a premium consumer experience while maintaining the maximum seat density in their highest grossing auditoriums.
So they don't lose the capacity.
Right. They are deploying capital with surgical precision, analyzing the specific supply and demand mechanics of every single real estate asset in their portfolio.
It is the definition of yield management. They are maximizing the revenue potential of every single square foot of real estate they own.
So we have unpacked the historical context, the revenue mechanics, the mix shift, the debt restructuring, and the CapEx strategy.
That's a lot of data.
It is. But it is time to synthesize this data into an actionable conclusion for the listener.
Okay, let's do it.
Based on this Q2 earnings call, are we looking at a bullish or a bearish signal for the underlying business?
Look, if we completely divorce the stock from the social media narratives and evaluate the company purely on its fundamental operating metrics,
Right.
this earnings report is a profoundly bullish signal.
I agree completely. And for anyone listening who wants the definitive proof of this turnaround, there is one specific comparative metric from this report that you really need to remember.
Oh, I know exactly which one you're going to bring up.
It is the ultimate distillation of everything we have discussed regarding operating leverage and structural efficiency today.
Let's compare this most recent quarter, Q2 of 2026, to Q2 of 2019.
Exactly. Q2 of 2019 represents the pre-pandemic baseline. The industry was healthy, the pipeline was flowing, and the macroeconomic environment was totally stable.
Right. And in Q2 of 2026, the aggregate North American box office was roughly 7.5% smaller than it was in that 2019 quarter.
But more importantly, physical attendance at AMC Theatres was down 26.5%.
Wow.
That means approximately 26 million fewer people walked through their doors this quarter compared to the same period in 2019.
Think about that. A smaller overall industry and a massive drop in raw physical attendance.
By every traditional metric of legacy retail, a 26% drop in foot traffic should result in a catastrophic drop in profitability.
Oh, usually it's a death sentence.
Yet, despite the smaller box office and despite serving 26 million fewer customers, AMC generated 6% more total revenue.
And an incredible 39.5% more adjusted EBITDA than they did in Q2 of 2019.
39.5% more profit on 26% fewer people.
That is the statistical proof of the turnaround right there.
It really is. It proves that AMC does not need the broader box office to return to the record-breaking volumes of 2018 or 2019 to be wildly profitable.
No, they have completely re-engineered the underlying mechanics of their business model.
Right, through the aggressive expansion of premium large formats, ruthless cost containment, the strategic culling of unprofitable real estate.
And, of course, that massive debt restructuring.
Yes. They have built a machine that extracts significantly more value from every single customer that walks through the door.
So for investors, the thesis has officially evolved. This is no longer a meme stock survival story.
Right, the survival phase is basically over.
The debt maturities are cleared until 2029, and the operating leverage is optimized. The narrative is now about execution, margin preservation, and cash generation.
Assuming the Hollywood studios can maintain a release schedule that supports that $10.4 billion baseline, AMC is structurally positioned to convert that top-line revenue into substantial free cash flow.
The financial scaffolding that kept the building upright for the last 4 years has finally been removed.
And it turns out the foundation underneath is remarkably solid.
Yeah, it really is.
But before we wrap up today, there's one final avenue of speculation that I think is crucial for you as investors projecting out over the next 5 years.
Okay, what is it?
We touched briefly on the merchandising revenue, right? Which went from 0 to a projected $100 million this year.
Right.
But we haven't discussed how they are connecting that retail expansion with their digital infrastructure.
Ah, you are referring to the AMC Stubs A-List subscription program.
Yes. For a monthly fee, subscribers can see up to 3 movies a week.
Which provides AMC with recurring, totally predictable subscription revenue.
And according to this earnings call, A-List members now account for a full 20% of AMC's total U.S. patronage.
Wow. 1 out of every 5 people in their domestic theaters is on a monthly subscription plan.
Yes. And those subscribers generate an immense amount of first-party data.
Oh, for sure. AMC knows exactly what movies they watch, what formats they prefer, what zip codes they live in, and what concessions they purchase.
Exactly.
Yeah.
So when you combine a massive, engaged subscription base with an exploding retail merchandise business, it sort of forces you to rethink how you categorize the company.
Right. Like, are we witnessing AMC transition from a traditional theatrical exhibitor, a utility that simply rents out screens to show movies, into a genuine experiential lifestyle and retail brand?
Yes. And the implications for their valuation model are massive if they can successfully make that transition.
I mean, if a consumer views AMC not just as a place to watch a film, but as a destination to collect exclusive merchandise, participate in premium events, and engage with a broader entertainment community,
The ceiling for their revenue per patron could be so much higher than any historical models predict.
if they are already generating record profits with fewer people, imagine the cash flow mechanics if they leverage that first-party data to sell a targeted collectible t-shirt, a branded popcorn tin, and a premium digital upgrade to every single subscriber on their list.
It transforms the unit economics of the entire business.
It's a fascinating evolution to monitor as we move through the back half of the year.
It absolutely is, and it underscores exactly why it is so important to look past the surface level narratives and dig into the actual operational mechanics of these companies.
Could not agree more.
Well, thank you all for joining us on this deep dive into the AMC Q2 2026 earnings call.
Keep your eyes on the data.
Keep questioning the consensus, and may your portfolio always be in the green. We will see you on the next one.